iTroops Mortgage Dad here, trying to demystify the mortgage process, one little bit of useless information at a time. No advice here, just information, just trying to give you something to arm yourself with facts when you go and sit in front of your mortgage broker or your mortgage advisor at the bank, or you try and figure things out on the internet yourself. So we've looked at previously how income determines how much you can borrow if you're employed. If you're self-employed, lenders hate you. This is going to be a world of pain. It's not that bad, sort of, if you're prepared. So typically lenders for self-employed clients are going to look for you to have been trading for 2 years, or submitted 2 years accounts, so potentially trading for maybe 2.5 years. Whether you're self-employed, whether you're a sole trader or limited company, to go for a high street lender, you're going to need typically 2 years sets of accounts. And the way that they'll take those into account is they'll average your earnings, whether it's net profit or whether it's salary and directors' dividends. They'll take an average of those over the 2 years, and that's the figure that they'll use in their affordability calculator to determine how much you can borrow. Which is great if you have had 2 consistent years, but maybe you've only been trading for 2.5 years and your first year was rubbish because it was your startup year. That average is going to become quite low. So there are off high street lenders who will work on your most recent year's accounts. The trade-off with that is you're going to pay a higher interest rate. Now, if you're a sole trader, they're going to look for your net profit figures. So ideally you want a net profit and not a net loss. And the kind of information that they'll look for to verify what your income is would be your tax calculations, sometimes known as an SA 302 or a tax computation, and there'll be another document called a tax year overview. Now both of these are available on the HMRC portal or through your accountant. If you use one, they can provide those for you, but you would need those 2 corresponding documents. Now for your previous year, your tax year overview is going to need to show that the tax that you were due has been paid, which sounds like a no-brainer, but it's not necessarily the case. People don't always pay their tax, or you might be paying it on an account, in which case you're paying a monthly amount to it. But lenders are going to look for your previous year's tax to have been shown as paid on your tax year overview. Doesn't matter so much on the current year, because obviously you've got until the end of January to pay it. So if you're applying on the 27th of January, then chances are they're going to look for that tax year overview to show that your tax has been paid. If you are a limited company director, slightly different. There's a couple of options here. Again, ideally you're looking for 2 years, but some lenders will lend against director's salary plus dividends. Other lenders will lend against director's salary plus share of net profit. So one of these might give you a slightly better borrowing entitlement than others, and again that will determine which lenders you would look at. And this is where using a broker, or actually using a broker is the only way you're going to find out, because going to your bank is going to have a set level of criteria, and if you don't fit that criteria, tough. Or if you don't get the best borrowing entitlement from that criteria, that's all they know. So if you want to figure out which way is better, you need to speak to a broker. And they'll be able to access every lender in the market, or most lenders in the market, and give you a kind of comparison between lender X and lender Y. And you can find that the difference in what can be borrowed can be quite significant. Lenders will also look at things like, where's there bounce back loans in play. They'll look at your kind of turnover, and they also would want typically to see business bank statements. Now, the reason for that is they want to see that the income is sustainable. You can also look to verify your income with an accountant's reference, and again that will just take the place of these HMRC documents. It'll provide the same level of information, but the lender will also ask the accountant to put some kind of commentary on it as to whether or not the business is sustainable or the income sustainable. and potentially they'll also do background HMRC checks, just to verify that the information that is on your tax calculation and your SE 302 and your tax year overview, is that the information that HMRC are aware of and have on file as well. And again, it may not be the case that is. So those are the factors that you need to look into in terms of determining how much you can borrow as a self-employed client. There is one variation to that, and that is applicants that are on the CIS scheme, construction industry scheme. Now, you have the choice. You can either be employed or self-employed in the lender's eyes if you're on the CIS scheme. Some lenders will look at the annual amount that you receive on your CIS payslips, and others will look at you as self-employed. So again, the lender that you go to will be determined by which is the better figure to be using. And again, that's something you're only going to know if you go to a broker. So that in a nutshell is what we need to look at for a self-employed income. It's probably not as difficult as maybe suggested at the start. At the end of the day, the whole point of this podcast, this video clip, is getting you prepared for your mortgage application so that you know what documents that you're going to need to provide when you're sitting down in front of your mortgage professional. And you're fully sort of aware of what the possibilities are, what the pitfalls are. If we can iron out all these things up front, it just makes the whole process far simpler, far less stressful, and it gets you the house you want. So good luck.